It's time for the Income for Life Daily Dime. Reactions and analysis on important financial news that impacts you in 10 minutes or less. Brought to you by the podcasting pros at Third Wheel Media. If you're a financial professional, estate planning attorney, real estate agent, or any small business owner, Third Wheel Media has a podcasting production package that fits your needs. Visit thirdwheelmedia.com to find out more. Now, here's today's Daily Dime.
Welcome to the Income for Life Daily Dime, powered by Third Wheel Media and our partners at Folds of Honor, as we have a quick 10-minute discussion in 10 minutes or less on a pressing topic or conversation that is going on out in the retirement planning and financial planning world today. And Nick, we have a great opportunity to talk about something right now that a lot of our clients and a lot of our listeners are very concerned about because they see it in the news all the time. And we actually pulled an article right here off of Market Watch just today, and we're talking about an inflation scare. And this particular article, Nick, that we're going to be discussing here on the Daily Dime is titled, "The Biggest Inflation Scare in 40 Years is Coming, What Stock Market Investors Need to Know." And I know, Nick, you and I both have some ideas about how we think inflation has an impact on not only just retirement, but kind of the mechanism of how. And it's a little bit different than what some people think. But when we explain this real quick in this Daily Dime, I think people will understand a little bit more about what we're talking about. So let's have a quick conversation in 10 minutes or less about the inflation scare that's going on right now.
Love it, Matt. And I agree. This inflation is not only a little bit scary and apprehensive for our clients, but anybody in the investing world. So the larger institutions are also very concentrated and focused on the inflation, the impact of it, and then what our government may or may not do because of this inflationary push right now with what we have. And unfortunately, right now, we're in kind of an up is down, good is bad type of structure, meaning good news about our economy is kind of causing the markets to move in the opposite direction.
Which is weird for a lot of people.
It is not a normal way that you think about it. You think that, well, we come out with a better than reporter or better than expected jobs report. You would think, well, the economy's opening back up. Things are looking better. We're getting closer to normal, back to 2019 pre-pandemic stuff. That should cause the market to continue to rise. Unfortunately, in this situation right now, it causes the opposite effect. And the reason...
And that's what we need to make sure that everybody listening understands is exactly that. I'm sorry I interrupted you on that because what we're dealing with right now is so upside down with what so many normal investors that are out there right now that have that 401k that they're thinking is, okay, well, yeah, the jobs report came back, better, whatever it might be. They're seeing signs of us getting out of this pandemic.
Correct.
But the market is kind of not reacting in the way that a lot of people are hoping it should. So let's dive into that.
It is confusing. People are starting to feel more positive about what's going on. Everybody's kind of getting out, doing the things that they used to do, but the market is then reacting on positive news in an incongruent fashion and not in the way that they would think. And that's because in these transitionary time periods, in a possible rising interest rate market, in a possible inflationary market, what we're looking at is when the jobs report comes out or some positive report comes out, then all these big institutions, these big investors are saying, well, okay, the government has been supporting us for the last 15 plus months of sending checks to citizens. The Federal Reserve has been buying bonds in the marketplace at an increasing clip, which is then if they're buying bonds, they're sending money into the marketplace. That artificially holds interest rates and inflationary pressure low. But if we start to get more positive news about the economy, the worry at these larger institutions, which then affects our clients and our investors, is that if the economy is getting better, then we don't need the crutch. We don't need the additional stabilizer of the government. And if the government stops doing what they're doing, then they could kind of have a more hands-off approach. Things start to stabilize or equalize on their own, which is going to cause possible interest rates to rise, possible inflation to happen in the marketplace, which then causes them to sell in that market. And we can dig into what's causing them to sell. And it's kind of a cool thing. But the baseline of it is good news right now about the economy can kind of cause bad news in the market. Most people don't think about it that way, but in the short term, it can cause some scary things to happen in people's portfolios.
And you think about that right there, about that crutch that you just said. The crutch that we're talking about is the federal government. The whole economy, everybody, you and me, that have been getting this, I don't want to necessarily call it free money, but it kind of has been, this really easy money because of the pandemic, because of clear back in 2008, whatever the scenario might be. We've had all-time low interest rates for a long time. This was happening before the pandemic. It just even got a little bit worse. So we have been conditioned as this country goes to really have all this free, easy money that is coming our way. And the government has been propping up the market. And they've been really doing it over the last 15 months, like you just said.
That's exactly.
So now, whenever the good news things start to happen, where the government is now able to at least consider taking those crutches away, which means we are now going to be standing on our own 2 feet. That's what that is. So if we're going to be standing on our own 2 feet as a country because they're going to be taking the crutches away, the marketplace is literally searching for reasons to sell.
Exactly.
And that is a reason. That is a reason to consider selling. So if you're looking at the inflation, you look at the low rates, you look at how they're trying to take the crutches away from us so we can stand on our own 2 feet, and you see the Wall Street guys literally looking for a reason to sell because they know that this market should never be at 34,000. They know that this market is overinflated, and they're looking for a reason to sell while the getting's good. That's what we're concerned about with this right now.
Correct. And our investors can get caught up in that chaff, in that wake, in that turbulence when they're trying to plan their retirement with their goals and needs and wants, and they get caught up in these larger movements, and all of a sudden the value of their retirement plan goes down 25% artificially, and they don't even know why. Things are supposed to be getting better. But when you start looking ahead, especially when our economy is based on these 5 to 10 large tech companies right now that have caused the stock market to go up, when these larger institutions start to look at how is that going to rebalance and reshuffle. In the long term, things are going to be okay. In the short term...
Short term is what our retiree and our clients need to be thinking about.
In the short term right now, they're looking at and saying, well, rates are at historically low. We don't have inflation. So when we look ahead and we value the future appreciation of these companies, we're discounting that at a very low interest rate. So that causes the stock price to appreciate. Now, if there's turbulence in the market and they think, well, rates could rise, then they start to adjust and recalibrate their calculations of what is the value of Microsoft if the interest rate isn't 1, but it's 3,
correct,
or 4, or 5. And when you recalibrate that and recalculate that at a different discount or different interest rate, all of a sudden those valuations look different. So then they say, well, we got to sell because those valuations are off and let that recalibrate in the short term, rebalance, let us get on our own 2 feet and stabilize.
Take the crutches away.
And long term we'll be fine. Amazon's, Microsoft's, Facebook's, they're going to be around.
Yeah, they're not going away.
They're going to be around to be just fine. But your portfolio in the midst of this short-term turbulence could be affected. And that's where we need to talk with our clients and our listeners that you need to set up your plan for retirement, your income plan and your investment plan to have some flexibility for this turbulent, but also have the foundation of guarantees to weather this coming storm because we know the turbulence is going to be there.
And if you don't have that stability in your retirement and you're listening to us right now and say, wow, that makes a lot of sense, then give us a call and we will absolutely explain to you how we can stabilize that so you can take advantage of this high market right now and have the guarantees moving forward and have the safety moving forward because this is coming. As soon as they officially pull those crutches away, this is going to happen. And it's not going to be anything that you don't know. You see it coming right now.
The rebalance is happening whether we like it or not. We got to be prepared for it. And we don't want our clients and our listeners to get caught up in this reshuffling and have it really affect their plans.
Absolutely. Well, that is our Income for Life Daily Dime today. A quick hit 10-minute discussion on a topic or conversation going on out there in the retirement and financial planning world today. We hope you enjoyed today's Daily Dime. And until next time, bye-bye for now.
This has been the Income for Life Daily Dime. Reactions to and analysis of the important financial news of the day in 10 minutes or less. For help with your financial and retirement plan, call 888-228-8814 or visit incomeforlife.org. Information provided on today's show is for informational purposes only and does not constitute investment, tax, or legal advice. Information is obtained from sources that are deemed to be reliable, but their accuracy and completeness cannot be guaranteed. Always consult with a qualified professional before taking any action.